Hello and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. Today I'm joined by Mark Jenkins, the head of Carlyle's $150 billion global credit business. Mark's had a 32-year investing career at Goldman Sachs, Canada Pension Plan Investment Board, and for the last 7 years at Carlyle. Mark, thanks for taking some time with us.
Thanks, Justin. Glad to be here.
So we just wrapped up the first half of 2023, and the top story for the investment universe continues to be inflation and interest rates. What are Carlyle's house views on those topics today?
Well, interestingly, CPI just recently was reported and came down to the lowest levels in 2 years at 3%. And that's very consistent with what we have been observing in our portfolio companies, the over 273 portfolio companies we have on our private equity side and the 1,200 plus credits that we cover, that we had noticed that inflation, albeit high, is still coming down, which is a good trend. The Fed continues to, work against inflation. It's pretty clear, at least to us, that the Fed will probably have one or two more increases over the course of the year. I think our long-term view is 2024. Could you see some cuts? Potentially, but I think we're going to be in an elevated interest rate environment for quite some time.
Okay, the other big story in the first half was the failure of Silicon Valley Bank and others, and the expected further bank regulation to come after that. How has that impacted the investment environment in private credit?
Yeah, certainly, as we saw the Fed increase rates over 500 basis points in less than 18 months, that had the unintended consequence of an event like the Silicon Valley Bank, basically liquidating over time. And that, of course, is creating a bit of an impact in the overall banking market, i.e. that credit conditions are now tighter, if they were, than the Fed had probably really intended, because banks are pulling back from lending from a regional perspective. We're starting to see the consumer sort of weaken a bit on the larger scale banks. And so the lending environment from the bank market is pulling back. Now, that's a good thing for us in private credit, of course, but the fact that the banks are doing that, plus the regulators are clearly going to have them hold higher amounts of capital, is going to exacerbate that environment.
Okay, looking forward now to the second half, what are some of the most exciting investment opportunities you see in private credit?
Yeah, as we look at how private credit in particular has repriced, and credit generally has repriced because of the increase in base rates, we see very attractive opportunities across the spectrum, but in particular in direct lending, we're either top of the capital structure, very safe place in the capital structure, you're seeing yields that are in excess of 10%. So call them equity-like types of yields that you're receiving for debt, which is very interesting. And also, you're seeing better terms and conditions, better covenants and better structures than we would have seen 24 months ago. Secondly, when we look at non-sponsor or entrepreneurially owned companies, we're seeing great opportunities there as well because of their what's going on in the bank market right now. It's making it more restrictive for them to fund in that market. And now the capital market's being shut down. They need access to capital, and the private credit market is providing that. And then as we look across our broad platform, you could look at things like infrastructure credit. We look into our CLO market as well. You look at real asset credit like aviation and real estate. All are repricing across that spectrum to provide great opportunities for our investors.
Yeah, with banks pulling back and yields at historic highs, it should be an interesting second half of the year. Now, one of the questions that I get a lot from investors is how to think about private credit in the context of a broader portfolio. Before you joined Carlyle, you managed a portfolio of about $60 billion at Canada Pension Plan across many, many asset classes. How do you think about the role of private credit in a portfolio?
Well, I think as all of our investors out there, you're looking to diversify in your portfolio. And private credit, and it's really just a credit exposure, is diversity in your portfolio. So that's point number one. It's not going to be the largest allocation, I would think. It'll be a allocation. And number two, from an illiquidity perspective, it provides that illiquidity premium that gives you a premium over the public market alternative. And in this market, that's remained relatively consistent through time. And I think those two aspects together generate great yields for your portfolio and are the results that I think all of our investors are looking for.
All right, so as we start the second half of the year, Mark, any final thoughts to leave us with?
Well, I think the final thoughts are, with all of the volatility that we've seen, not over the past 6 months, but really the past 36 months, is we're just not great at predicting the future, but all we can really do is prepare for that. And I think our broad, diverse portfolio allows us to invest through cycles for our investors, so we're ready for that.
Mark, thank you so much for your insights today. And thanks to all of you for tuning in. We will see you next time on Insights from the PM's Desk.